What is a contract for difference? A contract for difference of CFD is a popular form of trading derivatives. It enables traders to speculate on the rising and falling prices of shares, indices, commodities, and foreign currencies. A CFD trade differs from traditional transactions. Specifically, it is to speculate on changes in the price of an underlying asset without the need to actually purchase the asset itself. For example, if a trader forecasts that the gold market will be strong, he can go long by buying gold CFD. Alternatively, the trader can sell it, and this is going short. When the market moves in line with a forecast, the trader will profit. If not, losses will be incurred. What are the features of CFD trading? CFDs are a leveraged product where traders only need to deposit a small percentage of the full value of the trade to open a position. For example, when gold is priced at $2,000 an ounce, only 1% of the gold price is required as an initial margin, or $20, to open a position with $2,000. The margin ratio varies slightly on each platform. The lower the margin ratio, the lower the cost will be. The higher the leverage and the greater the potential return. Notably, in case that the market moves against the trade's forecasts, losses are calculated on the full value of the trade. This may lead to the losses exceeding the initial margin, so traders should be especially alert to the risk of high leverage. A negative balance protection function is available on Mitrade to protect the trader from a loss exceeding the trading principal. Mitrade, trading simplified.